SanDisk may be the wildest AI stock most people still are not talking about enough. This is not NVIDIA. This is not Palantir. This is not Tesla. This is a memory and storage company that has become one of the biggest winners of the AI infrastructure boom. The stock has been reported as the top-performing S&P 500 name of 2026, with gains of more than 800% at one point this year. But now comes the uncomfortable part. SanDisk just dropped more than 14% in one session. The stock traded from an intraday high above $2.100 down to around $1,745, with a market cap still near $274 billion and a pay ratio around 61. So here is the real question. Is this just a normal pullback after a monster rally? Or is the market starting to realize that the AI storage boom is still a memory cycle, and memory cycles can turn very fast?
That is exactly why SanDisk is interesting right now. The bull case is obvious. AI needs storage. AI servers need high-performance SSDs. Data centers need more memory, more storage, more bandwidth, and more capacity. Every time companies build larger AI clusters, the amount of data moving through the system explodes. The old way to look at SanDisk was simple: flash memory, SSDs, storage devices, consumer and enterprise demand. The new way to look at SanDisk is very different: AI storage infrastructure. That change in perception is what drove the stock so violently higher. The market stopped treating it like a boring storage company and started treating it like an AI hardware beneficiary.
And to be fair, the bull case has real logic behind it. AI is not just about GPS. GPS do the computing, but data has to be stored, retrieved, moved, cached, and processed. Training large models and running inference both create massive demand for fast storage. If AI workloads keep growing, storage does not stay in the background. It becomes part of the bottleneck. That is where SanDisk benefits. Enterprise SSD demand improves. Pricing improves. Margins improves. And when memory pricing turns, earnings can move much faster than revenue.
Exactly. That is the key with memory and storage stocks. They can look dead for years, and then when pricing tightens, margins explode. This is why the stock can move so violently, but that is also the risk. Memory is not software. It is not a subscription business. It is not a clean recurring revenue model. It is a cyclical hardware business. When supply is tight, pricing power looks amazing. When supply catches up, pricing can fall. Margins can compress, and the same operating leverage that helped earnings on the way up can hurt earnings on the way down.
So the bull case is AI demand and tight supply. The bear case is that investors may be paying peak cycle multiples for a company in a historically cyclical industry. And that is the tension. SanDisk is not falling because the story disappeared. It is falling because after an 800% type rally, the market starts asking a different question. How much good news is already in the stock?
Right. A 14% drop in one day does not automatically mean the business is broken, but it does mean expectations were extremely high. At around $274 billion in market cap and roughly 61 times earnings, SanDisk is no longer priced like a neglected memory name. It is priced like a company where AI demand continues, pricing stays strong, supply stays disciplined, and margins remain elevated. That is a lot to ask from any memory company.
Let us break down the bull case first. Bull case number 1. AI storage demand is real. This is not just a social media narrative. Memory and storage stocks have been moving because hyperscalers are spending aggressively on AI infrastructure. NVIDIA gets the headlines, but the server ecosystem around NVIDIA also benefits. That includes networking, power, cooling, optical components, DRAM, NAND, SSDs, and storage systems. SanDisk sits in that storage layer. If AI infrastructure keeps expanding, storage capacity has to expand with it.
Bull case number 2, pricing power. In memory, the most important variable is not just volume, it is price. When NAND or SSD pricing improves, the earnings impact can be huge. This is why the stock market reacts so aggressively to signs of a memory upcycle. A few quarters of better pricing can completely change the profit profile. Investors are not just buying current earnings, they are buying the possibility that earnings are still moving higher as pricing remains strong.
Bull case number 3. SanDisk has become a pure AI storage trade. That matters for investor psychology. In a market where everyone is looking for the next AI beneficiary beyond NVIDIA, SanDisk gives investors a clean narrative. AI needs data. Data needs storage. Storage demand drives pricing. Pricing drives earnings. It is simple. It is easy to explain, and simple stories can attract a lot of capital.
Now the bear case. Bear case number 1, the stock already ran too far. This is not a stock quietly sitting at a cheap multiple after a small bounce. This was one of the biggest winners in the entire market. When a stock rises several 100% in a short period, even a good business can become a dangerous stock if expectations get too stretched. The question is not whether SanDisk is benefiting from AI. The question is whether the stock already priced in too much of that benefit.
Bear case number 2. Memory cycles have a long history of hurting investors at exactly the wrong moment. The pattern is always similar. Demand improves. Prices rise. Margins expand. Investors get excited. Companies increase supply. Customers build inventory. Eventually, the shortage becomes balanced, and sometimes the balance becomes oversupplied. When that happens, pricing can reverse quickly. That is why memory stocks can be so dangerous near the top of a cycle.
Bear case number 3, AI demand may be real, but it does not eliminate cyclicality. This is the part investors need to be careful about. A strong secular trend can exist inside a cyclical industry. AI can create real demand growth, but if supply expands too fast, or if customers pause orders after building inventory, pricing can still weaken. AI does not magically turn memory into software.
That line is important. AI does not magically turn memory into software. SanDisk may be a major beneficiary of AI infrastructure, but the business still depends on hardware pricing, capacity planning, and capital discipline across the industry. That makes the stock very different from a pure software company with recurring subscription revenue.
Now compare SanDisk with Micron. Micron is more tied to DRAM and HBM, which are directly connected to AI servers and high bandwidth memory demand. SanDisk is more tied to NAND, flash, SSDs, and storage. Both can benefit from AI, but the demand drivers are not identical. Micron has also had a massive run and recently pulled back sharply. That tells you this is not just a SanDisk-specific issue. The whole memory complex is dealing with the same debate, AI supercycle or overheated memory trade.
And that is why SanDisk is a perfect bull versus bear stock. The bull says AI storage is just getting started. Data center demand is enormous. Pricing is still strong. Margins can keep surprising. The company is now central to AI infrastructure. The bear says the stock already went vertical. Earnings multiple is no longer cheap. Memory is still cyclical. A 14% drop may be the first sign that the market is starting to question peak expectations.
So what should investors watch next? Not opinions, not hype. Watch for signals. First, watch NAND and enterprise SSD pricing. If pricing keeps rising, the bull case stays alive. If pricing flattens or turns down, the stock will have a harder time defending its valuation. Second, watch data center demand. SanDisk needs AI infrastructure demand to stay strong, not just for one quarter, but for multiple quarters. Third, watch gross margin. Revenue growth is good, but in memory stocks, margin tells you whether pricing power is real. Fourth, watch management commentary on supply. If the industry starts adding too much capacity, investors will quickly start worrying about the next down cycle.
So let us bring it back to the core question. Is SanDisk still an AI storage winner? Yes, the business logic is real. But is the stock risk-free after an enormous rally? Absolutely not. A stock can have a real AI story and still be vulnerable if the valuation is too far ahead of the cycle.
That is the most balanced way to look at it. SanDisk is not just a boring storage company anymore. The market has reclassified it as an AI infrastructure stock. That reclassification created massive upside, but the same reclassification also created massive expectations. At this stage, SanDisk does not just need a good story. It needs continued pricing strength, continued AI demand, continued margin expansion, and continued discipline across the memory industry. That is a high bar.
Final question. Is SanDisk still early in the AI storage boom? Or is this 850% rally already pricing in the best part of the cycle?
This content is for informational and educational purposes only and does not constitute investment advice.
Always do your own research. Investing involves risk.